Bismillahirrahmanirrahim. This is the first video on financial statement analysis. And in this video, we will give an overview of financial statement analysis and the 6 steps analytical framework, that is the logical structure for financial statement analysis and valuation. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. Any investor will first analyze the economics of an industry and then decide the firm he should make an investment. For this, the investor will make the financial statement analysis of the firm in order to determine its future profitability, growth, and risk. In order to analyze the financial statement, one must have a good understanding of the accounting principles and methods that are stated in the GAAP, that is Generally Accepted Accounting Principles, and IFRS, that is International Financial Reporting Standards. These principles and standards help us to measure and report the financing, investing, and operating activities of the firm. The financial statement help us to forecast how the future financial statements will look like. It helps us to determine the future earnings, the future cash flows, the dividends, and the future value of the firm. The objective of financial statement analysis is to determine if a firm's shares are fairly priced by the market or not. For this, a security analyst must have a good understanding of business models, market presence, and financial decisions. He must also have a good understanding of various analytical tools and techniques that are used in financial statement analysis. The role of security analyst is to gather and scrutinize data from financial statements and other sources, evaluate historical and current performance of the firm, forecast future trajectory based on performance analysis, estimate the value of the firm's shares using projections derived from financial analysis, compare estimated share value with the current market price. This helps an investor to make informed investment decisions driven by thoughtful assessments. Financial statement analysis techniques are used in various decision making scenarios in addition to assessing the firm's value, like communicating financial results to investors, creditors, employees, and stakeholders, evaluating the firm's creditworthiness for short term financing and long term asset acquisitions, analyzing the performance and stability of suppliers, customers, competitors, and potential partners, assessing opportunities for mergers, acquisitions, and divestitures, valuing initial public offerings and providing strategic advice, and determining damages in local disputes and conducting financial statement audits. Next, let us talk about the logical structure for financial statement analysis and valuation that will form the foundation of these discussions. This includes analyzing the industry's economic environment to understand its impact on profitability and risk, evaluating the firm's strategies for differentiation rather to assess competitive advantages, durability of earning growth, and associated risk, and reviewing the firm's financial statements and accounting methods to assess the reliability and usefulness of the information provided. These are the six interrelated sequential steps to analyze financial statements. So let us first of all talk about number 1, that is identify economic characteristics and competitive dynamics in the industry. So, analyzing economic characteristics and competitive dynamics of the industry involve access competitive forces, including the number of firms and product differentiations, evaluate technological advancements impact on competitive advantages such as in computer software, establish the economic context for subsequent analytical steps in financial statement analysis and valuation. Next, number 2, to evaluate accounting information effectively, consider how the firm achieves and maintains its competitive edge through its unique business model, the duration of these competitive advantages, market forces such as niche markets, example ethnic foods, or broader sectors, example grocery stores, vertical integration into raw material production, geographic and industry diversification. So, these insights are vital for assessing profitability, risks, and forecasting future activities. Then, number 3, assess the quality of the firm's financial statements. That is, to assess the quality of the firm's financial statement, they should evaluate if the financial statements reflect sustainability and comparability, determine if they provide a complete view of economic performance, financial position, and risk, confirm adherence to either US GAAP or IFRS standards, analyze if earnings include non recurring items like goodwill written off, investigate if the firm uses transactions or accounting methods to enhance profitability or reduce perceived risk. So, understanding the quality of accounting information is crucial for analyzing profitability, risk, and projecting future financial statements. To analyze the firm's current profitability and risk, evaluate return on assets to understand how effectively the firm is using its assets to generate profit, assess return on equity to gauge the return for common equity shareholders, monitor trends in profit margins to see if they are improving or declining over time, compare these metrics with key competitors to assess relative performance, examine the firm's leverage through its capital structure ratios. These analyses help in understanding the firm's profitability and risk, providing insights crucial for projecting future performance and valuing its shares. The fifth step is project future financial statements. So, future resources, obligations, investments, and cash flows are what we are going to analyze over here. uh, projected revenues and expenses, expected future profitability and risk, potential returns from investing in the company. These forecasts rely on projections of the firm's future operations, investments, and financing activities. They serve as a foundation for financial decision making and company valuation. Financial analysts evaluate the value of the firms to recommend buying, selling, or holding equities. They assess whether the market price reflects undervaluation, overvaluation, or fairness. Investment banking firms determine the initial offering price in initial public offerings, that is IPOs. Anal- Analysts in corporations they assess a range of values for acquisitions or divestitures to determine bidding or expected proceeds. So these six steps form a structured approach to analyze and value a firm. They help answer complex questions about company evaluation. Each step builds upon the next, providing a framework to develop skills in company analysis and valuation. Inshallah, in the next video, we will talk about how the six steps relate to share pricing in the capital markets. So this completes the third video on financial statement. The first video on financial statement analysis. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.